We're back, and Bob Pisani has our ETF edge today. Hey, Bob.
Hello there, Scotty. Gold prices are pulling back a bit from their record highs today as the dollar strengthens, but the year's bull run for gold is undeniable. It's up more than 30%. Gold ETFs are following suit. How much more is there left for gold at this point? Let's talk about it with Tom Lydon, CEO of ETF Trends. Jan van Eck is the president and CEO of Van Eck. He runs the Van Eck Vectors Gold Miners ETF, GDX, up 52% so far this year. Jan, let me start with you. You did a paper last week arguing that gold could go from $1,900 to $3,000. You mentioned gold as a deflation hedge. Why have you become so bullish on gold so suddenly?
Well, basically became really bullish last summer when gold broke out of its 6-year sort of sideways market. And then the other technical confirmation happened when it went to all-time highs a month or so ago. It went through the $1,800 an ounce and then the 1921 level. So we've got the fundamental support of very low interest rates from the Fed, historically low rates. And if you look at prior cycles, we're not trying to make it up. We just said look at prior cycles. And that, in a low inflation environment, gets you to $3,400 an ounce, actually.
You know, Tom, the problem I've got with the gold bugs is they try to argue it both ways. I mean, they used to argue gold was a hedge against inflation, and now there's arguments being made that gold is a hedge against deflation as well. Can you actually make both of those arguments? I mean, or it seems like heads you win, tails you win with gold on those kinds of arguments.
Well, you're right, Bob. However, in this environment, the moon and the stars seem to be aligning really well for gold. When you talk about potential inflation, we're starting to see it at the grocery store. Part of that is the connection between getting food into the stock market. I mean, into the markets. The other thing is, which is really key and critical, you're seeing a lot of real estate start to go up in value outside in suburb areas as people are moving out of the city. Those things are really key and critical as people are anticipating inflation. One key thing about gold that we don't spend enough time on is supply and demand, where emerging market countries are really buying gold to a great extent, and there really isn't that much gold in the ground, and it's taking more and more money to get gold out of the ground. Hence, do you buy the metal itself, or do you buy the miner? And we could spend a lot of time talking about that.
Yeah, there's a lot of different ways you can slice and dice all of this. I just want to know the GLD, the largest gold ETF, now the 6th largest ETF in the United States, $83 billion in assets under management. We're going to talk a lot about this. We're just getting started here on ETF Edge. Catch our live online show at 1 p.m. Eastern Time. etfedge.cnbc.com. We'll be joined by Ben Carlson of Ritholtz Wealth Management to talk what could be a record year for the ETF business, believe it or not. And, of course, we'll get deeper into gold and whether you should be holding gold or gold mining ETFs. Don't miss all of that. Scott, back to you.
All right, Bob.